Good morning, everyone. So today is our second day on financial instruments, a very important standard. So we had started our discussion in the last class, and we were looking at the definition of what is a financial instrument. It is a contract which gives rise to a financial asset for one entity. Simultaneously, it gives rise to a financial liability or equity for the counterparty. Okay, so the important words is it is a contract. It is a contract between the two parties. So then we moved on to look at what is a financial asset and what is a financial liability. So when we saw the definition of financial asset, we said that it could be cash, it could be equity instrument of another entity, or it could be a contractual right to receive cash or equity instruments or financial asset. Okay, so that is what is the definition so far that we have seen. It is a contractual right to receive cash or another financial asset from another entity. And we have also seen at the same time what is a financial liability. Okay, obviously cash is not a liability, so that won't come. Own equity goes and sits under equity, so therefore it will not be here. So therefore this turns out to be a contractual obligation to deliver cash or another financial asset to another entity. So this was what we had seen in detail in the last session. We also saw the meaning of equity as well, where equity spoke about an instrument that gives a residual interest in the assets of the entity after deducting all its liabilities. Okay, so there is no voting rights, differential rights, all of that is not given. It's a plain simple instrument that has a residual interest. So this was what we had seen in the initial parts of the session. Towards the closing, we started to discuss about derivatives, and in the derivatives aspect, we saw what is included in what is the meaning of derivative contracts. Yes, deriving value from an underlying asset, settlement happening at a future date at an agreed price, and initial amount that will be paid is going to be nil or insignificant compared to the value of the contract. So this was what we had seen. And we also saw the three types of derivative contracts. We just discussed the features. One is your forward contract, one was your futures contract, and then the other one was the options contract. So we saw that in a forward and future, it could result in a gain or a loss, but in an options contract, there is an unlimited upside with a nil downside. Okay, so we saw the remaining part of the definition, the second leg, that is conditions potentially favorable to the entity when you exchange financial assets, or conditions unfavorable to the entity when you exchange financial assets or liabilities. Is it okay? So till now, is it clear? We saw the examples also, what could be included in financial assets, what could be included in financial liabilities. So till now, is it clear? Yes. Anybody has any doubt so far in what was discussed in the last class? Yes. Because now today, we can then proceed further. Okay. Yes, all clear so far. Anybody has any doubts? Good morning, Sriram. Good morning. Yes. I hope it's all clear. Okay. Okay. So anyways, let us proceed further. Now coming to our derivative instruments. Okay, coming to our derivative instruments. It could be forward, it could be future, it could be options. We have discussed all the three in brief. Those features are enough for us at the moment. If there is anything, we will put that in perspective as the sessions progress. Okay, so coming to our next discussion on derivatives. This could be forward contract, futures contract, or options contract. Now, when I talk about a derivative contract, The settlement has two options. The settlement has two options. The first option is a gross settlement. The first option is a gross settlement. The second option, obviously opposite of that, net settlement. The first option could be a gross settlement. The second one could be a net settlement. So what do you mean by gross settlement or net settlement? Okay. So gross settlement means what? Suppose in our example, we had entered into a forward contract to purchase $1,000 at rupees 80 per dollar. I hope you remember this. So $1,000 at rupees 80 per dollar is what we had entered into. So now, in a gross settlement contract, pay rupees 80 per dollar into $1,000. So you would be paying 80,000 to the bank and in return receive $1,000. In return, you will receive $1,000. Is it okay? So the worth of these $1,000, depending on the spot price at that date, could be, if it is 85 per dollar, then it could be rupees 85,000. Okay, this is only the worth, but because you entered into a forward contract, the price was frozen on the date when you entered into the forward contract. So you are paying 80,000, getting $1,000, but the value of that $1,000 in today's terms is 85,000 because of the exchange movement. So this is known as gross settlement. This is known as gross settlement. Now you could replace this dollar by any commodity or equity share, whatever you want, it will still remain a gross settlement. Suppose you've entered into a contract, into a forward contract to buy Reliance Industries shares for rupees 2,500. Now, in the future, when the Reliance shares go up, you will be getting the Reliance shares at 2,500 only. Suppose the price becomes 3,000. You are getting one share worth 3,000 in the market, but you are paying 2,500. So we call that as a gross settlement. There is a movement of complete amount to the counterparty, and in return you actually have the asset getting delivered to you. So it could be any asset. Okay, it could be any commodity, it could be any asset, it could be equity, whatever it is. Okay, so you can write here as could be any asset such as equity shares, bonds, or it could be even commodities, such as wheat, gold, oil, etc. Have you understood gross settlement? Good morning, Namrata. Good morning, Viraj. Good morning, Purnima. Yes. So have you understood gross settlement? Yes. Yes. Have you understood gross settlement? Now, if you have understood gross settlement, you should be able to help me out with net settlement. You should be able to help me out with net settlement. You have a forward contract, the same example I am extrapolating on the net settlement side. You have a forward contract to purchase dollars at rupees 80 per dollar for purchasing $1,000. On the date of settlement, the dollars are worth 85 rupees in the market. So in the case of net settlement, what is going to be done? I need you to help me out. In the case of net settlement, that is right. Kaushiki gave the right answer. In the case of net settlement, the bank will tell you, or you can tell the bank, yaar, what is this? I pay you 80, you pay me something worth 85. Ye sab nahi chahiye. Instead, what you do is you pay me net 5,000. The contract is settled and I will go and buy the dollars in the market at 85. Is it okay? Yes, it's the same thing. Yes. So therefore, net receive rupees 85 per dollar minus rupees 80 per dollar into $1,000. So that comes to rupees 5,000. We call this as net settlement. We call this as net settlement. In net settlement, the party that has to pay the net amount will pay it off and the contract is closed from both the sides. Okay. तो इसको हम लोग बोलते हैं net settlement. Sir, can we have net settlement only in currency forward? Not necessary. Suppose you have entered into a contract to buy Reliance shares at 2,500. Today the market price of Reliance is 3,000 on the settlement date. What you will tell the counterparty? You don't spend 3,000 and give me the share. I will not spend 2,500 and give you the amount. Instead, what you do is you just give me the net amount of 500. I will buy the share from the market at 3,000. So this is what is known as net settlement. So you can thereafter buy the dollars or whatever asset it is from the open market. Okay. So buy in open market thereafter. Okay, and this could include other shares, other assets like equity, bonds, commodities. Whatever is there, you could be having a net settlement clause that could be fitted in the contract, and that takes care of the entire settlement, okay, to be done on a net basis. Okay, just bear with me because I need us to understand why this is important for us. Okay, this is primarily because I'm explaining this because I want you to understand that not every derivative is a financial instrument. See, the immediate thought process of any student is derivatives complicated. More complicated standard is financial instruments. So both the complicated things are obviously married to each other, and that is why you put derivatives in financial instruments. Okay, it's not necessary. Financial instruments could include derivatives, but not all derivatives are financial instruments, is what I would like to show in the next is what I would like to show right now. That is why these examples. Okay, so now coming to our examples with the help of the futures options which we have discussed. Okay, consider 4 assets: currency, equity, bond, commodity. Okay, so I have these 4 instruments for which I have entered into, say, a forward contract. For which I have entered into, let us say, a forward contract. Okay, I'm summarizing it exactly right now, so you can just pay attention. I'm entering into a forward contract to buy currency. I'm entering into a forward contract to buy equity. I'm entering into a forward contract to buy a bond. I'm a bond, debenture, whatever, or I'm entering into a forward contract to buy a commodity. It could be gold, oil, rice, wheat, whatever it is. Okay, so now in the case of currency, can I have a gross settlement? Please answer the moment I ask a question. Can I have a gross settlement? Sir, what is gross settlement? We saw the example, 85,000 worth dollars I receive and I pay 80,000. So can I have a gross settlement in the case of currency? Yes or no? Can I have a gross settlement? Yes. So when I have a gross settlement, what does it mean? I'm getting dollars. What is dollar? Dollar is currency. What is currency? Currency is cash. Is cash a financial asset? Answer is yes. So you are having a right to receive a financial asset. In return of the dollars, what are you paying? Sir, I'm paying the amount in INR. So do you have an obligation to deliver cash? Yes, you have an obligation to deliver cash worth 80,000. So is the gross settlement meeting the definition of financial asset and a financial liability for the counterparties? Yes. I'm not saying asset liability for the same party. I'm saying in the same transaction, is it a financial asset for one entity? Is it a financial liability for another entity? Answer is yes. So therefore, this meets the requirement of a financial liability. Why? Because there is a currency that is being exchanged. I am getting dollars in exchange of INR. I am getting dollars in exchange of INR. So this meets the definition of a financial asset or a financial liability, as the case may be. Are you convinced about this gross settlement? Are you convinced about this gross settlement? What is this? This is basically contractual right or obligation to pay rupees 80,000 and receive $1,000 at rupees 85 per dollar. Is it okay? Yes. Yes, obviously cash, it's not saying only INR, right? Where is the standard saying? The standard is not saying only INR. The standard says cash. Cash could mean any currency. Okay. It should have the features of cash. That's it. Okay. Rupees 85 per dollar. Is it okay? Yes. So gross settlement, does it meet the definition of a financial asset or a financial liability? Yes. Right now, don't go into thinking kiske liye asset hoga, kiske liye liability hoga. The time will come for that. What I want you to understand is gross settlement in this case meeting the requirement of a financial instrument? Is gross settlement meeting the liability of meeting the definition of a financial instrument? Absolutely yes, because there is a currency that is being exchanged and currency is cash. Cash is a financial asset and obligation to deliver cash is a financial liability. Is it okay? So ye ho gaya mera gross settlement. It comes under financial instruments. Okay. All right. Net settlement. Net settlement. Okay. What happens in net settlement? What happens in net settlement? Sir, look at our example. I tell the bank or the bank tells me, look, why I should pay you 85,000 worth of dollars and why you should pay me 80,000 worth of INR. Let us do one thing. We will settle this contract by entering me, that is the bank, paying the option holder, that is paying the option holder or paying the forward contract holder net 5,000 rupees. So there is a movement of 5,000 rupees. So there is a right or obligation to deliver, or sorry, not deliver, it should be to receive / deliver rupees 5,000. Do you agree to this? Yes. Net settlement, there is a right or obligation to receive or deliver rupees 5,000. For the person who has entered into the contract to buy the dollars, for him it is a right. For the bank, it is an obligation. Yes. So now I want you to tell me, is this meeting the definition of financial asset as well as a financial liability in the opposite parties' books? Tell me, is it meeting the definition of financial asset / liability for the parties in the different books? Yes or no? Yes. Yes. It is meeting the definition of financial asset slash liability. Yes. And therefore, will the net settlement of a currency forward contract be a financial instrument? Yes. So in the case of derivatives involving currency, whether it is gross settlement or whether it is net settlement, we are not really bothered because both of them meet the definition of financial asset as well as a financial liability. So therefore it becomes a financial instrument. In the case of gross, also in the case of net also. It is a financial instrument, a financial asset for the party entering into the contract, and for the banker in our example, it is a financial liability. Okay. So this is done. Coming to the next case, that is equity. Gross settlement. Gross settlement. Okay. Space. Okay. Okay. Equity. Yes, that is right. Now you tell me, in gross settlement of a contract to buy equity, I have entered into a contract to purchase one share of Reliance Industries for rupees 2,500. The market price today is 3,000. So therefore, if it is a gross settlement, you tell me, is it going to be a financial asset? Is it going to be a financial asset? Is it going to be a financial asset? Yes or no? Yes, it is going to be a financial asset. And if it is a counterparty other than Reliance Industries, then it could be obligation to deliver other financial assets. Look at the definition. Look at the definition of financial liabilities. It is a contractual obligation to deliver cash or other financial asset. Other financial asset includes equity instruments of another entity. And therefore, in a gross settlement of an equity forward or equity futures contract, it could meet the definition of financial asset as well as liability. If you enter into this contract with Reliance itself, it could be a contract for equity as well. We'll come to equity, that aspect in a short while in today's class. But as of now, is it meeting the definition of a financial instrument? Absolutely yes. And therefore, gross settled equity derivative contracts are also going to be covered as financial instruments. Okay. Coming to net settled. I have entered into a contract to buy Reliance shares for 2,500. The market price on the date of settlement is 3,000. So therefore, you tell that I will not pay you 2.5. You need not pay me 3. You need not give me the share of Reliance. Instead, you pay me net 500. Is the net settled contract meeting the definition of a financial asset slash liability? Is it meeting the definition of financial asset slash liability? Net settlement. Obviously, because the 500 rupees is a financial asset for the receiver, is having a contractual right to receive 500. For the counterparty, it is a financial liability because there is an obligation to deliver rupees 500. Okay, there is an obligation to deliver rupees 500. So therefore, this also meets the definition of a financial asset slash liability. So these contracts also become what we call as financial instruments. Yes, these contracts become what are known as financial instruments. Okay, so now we have studied equity derivatives, settled gross or net. Currency derivatives, gross or net, all of them are financial instruments. Coming to the next one, bond. I go in for a gross or a net settlement. Okay. So is bond a financial asset for the holder of the bond? Obviously, because it gives a contractual right to receive interest as well as principal. So therefore, bond is a debenture. Bond is a debenture, and therefore, bond, you can take it as a debenture, and therefore it is a contractual right to receive interest as well as principal. And therefore, you are entering into a contract to purchase a bond of 1000, the market price of which is 1200. So there is an obligation to deliver the instrument as well as a right to receive the instrument. So therefore, this is also meeting the requirements of a financial asset / liability. So gross bond is a financial instrument. Obviously it is, because what is a bond? Suppose you have Tata Motors bonds which are listed on the stock exchange. So when you are entering, it's just a share, right? It's just something like a share, okay, and not a share. It is something like what you thought about shares. The bonds are traded. So today you've entered into a contract to purchase the bond for 1000 rupees. The bond is traded for, let us say, 1100 rupees. So therefore, the gross settlement will require that the bond worth 1100 be delivered to you. And in return, what you will be doing is you will be paying 1000 rupees. So for the counterparty, there is an obligation to deliver the bond to you. So when there is an obligation to deliver the bond of another entity means deliver another financial asset. Financial liability definition is a contractual obligation to deliver cash or another financial asset. Okay, so he's having an obligation to deliver the bond to us. Bond is a financial asset. So there is a contractual obligation to deliver a financial asset. At the same time, I am having a contractual right to receive the financial asset. I am having the contractual right to receive the financial asset. So both the sides, financial asset, financial liability is met, and that is why it becomes a financial instrument. Similarly, if I tell the counterparty, don't give me the bond, the differential in the prices is 100 rupees. You just pay me 100 rupees and I am done. This is now giving right to a contractual obligation to receive cash worth 100 rupees. This is now giving a contractual right to receive cash worth rupees 100. And therefore, will this become a financial asset, financial liability? Answer is yes. And therefore, bond net derivatives also go ahead and sit under your financial instruments definition. Is it clear so far? Janvi, did you follow? Yes. Kaushiki, Shriram, Akash, Viraj, Purnima, did you guys understand so far? Yes. Did you guys understand so far? I'm not saying convertible debentures right now. Okay. I'm not saying convertible debentures. Okay. I'm saying a normal debenture. Convertible debentures are financial assets, but I'll come to that later. Okay. Okay. But right now I'm talking about a normal bond, a normal debenture. Okay. If I said convertible debenture, that is not right. Okay. But we'll come to that. Okay. We'll come to that. We have lot of questions on convertibles. They are definitely financial assets / financial liabilities. We will see how it is. Okay. We'll look at it right now. Okay. Yes. If I said, it must have been a slip of a tongue, but they are not. Okay. So as of now, is it clear? Currency, equity, bond. Yes. Commodity, coming back to gross / net. Okay. Now, commodity means gold. Commodity means oil. Commodity could mean wheat. Commodity could mean anything other than financial assets. Now, in the case of gross settlement, suppose you have entered into a contract to buy 10 grams of gold for 55,000 rupees. Suppose you have entered into a contract for buying 10 grams of gold at 55,000 rupees. Today, the price of the gold for 10 grams is 61,000 rupees. The price of the gold is 61,000 rupees. So under gross settlement, what are you going to do? You will go to, let us say, Tanishq, and to Tanishq, you will present the contract and say, look, as per the contract, I have to pay you 55,000 rupees and you will give me gold, which is today valued at 61,000 rupees. You will give that to me today. And Tanishq has to fulfill the obligation. Tanishq has to fulfill the obligation. Now I want you to tell me, there is a contractual right. Yes. What is the contractual right for? Sir, the contractual right is to receive 10 grams of gold. The contractual right is to receive 10 grams of gold. You tell me, 10 grams of gold, is it a financial asset or a non-financial asset? Is it a financial asset or a non-financial asset? Tell me. Is it a financial asset or not a financial asset? There is an obligation to pay cash. You have to pay 55,000 rupees. I hope you understand that. But in return, what are you going to get? In return, what are you going to get? Sir, in return, you are going to get gold worth 10 grams. So is 10 grams of gold a financial asset? Answer is no, it's not. It does not fit into the definition. So any commodity, wheat, suppose you have a contractual you have entered into a wheat futures, a wheat forward contract for purchasing 100 tons of wheat. So what are you going to get? On the date of settlement, you will get 100 tons of wheat. You are not going to get cash for that. You will get 100 tons of wheat जो आपके गोडाउन में आके unload किए जाएंगे. Is 100 tons of wheat financial asset? Answer is no, it's not. And therefore, gross settled commodity derivatives. Gross settled commodity derivatives. No, gold is not a financial asset. Gold is not a financial asset. Did I do that? I cannot go so wrong here. Let me just check. Where did I mention that gold is a financial asset? Oh, it's not. I forgot to cross it off. Gold is not a financial asset. Okay. Gold is a non-financial asset. Okay. Maybe crossing, I did not do that. But in the discussion, I would have said that it is a non-financial asset. Okay. All right. So in this case, this is not a financial instrument. Why? Because you have a contractual obligation to deliver or receive something which is not a financial asset. And therefore, it is not going to be our financial instrument. However, the same contract on a net basis, is going to be a financial asset or a financial liability. Sir, why you say financial asset or financial liability? Because you have a contract to receive 10 grams of gold for rupees 55,000 rupees. The market price is 61,000. You go to Tanishq and say, look, I don't need 10 grams of gold, but I have this contract that entitles me to buy it for 55,000 rupees. So instead, what you do, you also don't give me 10 grams of gold. You give me the net amount, 61 minus 55, that is 6,000 rupees you pay me. So here there is a contractual right now to receive 6,000, and for Tanishq it is a contractual right to pay 6,000. So now in the case of net settled commodity derivatives, I want you to tell me, is it going to be a financial instrument or not? Financial asset for the party, financial liability for Tanishq in our example. Okay. Is it going to be a financial instrument? I have a right to receive 6,000. Tanishq has an obligation to pay 6,000. So is it a financial asset and a financial liability? Yes. So this meets a financial asset / financial liability definition, and therefore this ends up being a financial instrument. So all your derivatives, are they financial assets, financial liabilities, or financial instruments? Answer is yes, except gross settled commodity derivatives. Except gross settled commodity derivatives. All your derivatives except gross settled commodity derivatives are financial instruments. Gross settled commodity derivatives do not fall under the definition of financial instruments, because there is a contractual right to receive non-financial assets, and non-financial assets obviously will not be fitting in the definition of financial assets. These contracts, we typically call it as own use exemption. We typically call it as own use exemption. 100 tons of wheat, 100 tons of wheat आपके पास है. So if you have 100 tons of wheat contract, what are you going to do? Obviously you will sell that, right? So therefore it is for your own use. When I say own use, it's not that कि 100 tons of गेहूं में आटा बना करके I will make rotis out of it. Okay, I can use it for my business as a part of selling, as part of my trading activity. Okay, so therefore these are typically known as own use exemption contracts. Okay, I will end up using this contract for my own use, and therefore they are excluded from the ambit of financial instruments. Okay, they are excluded from the ambit of financial instruments. Is it okay? Yes. Have you understood in detail derivatives, what is included, what is not included? Anybody has any doubts so far? Anybody has any doubts so far? Yes, Namrata, Janvi, did you follow? Yes. Yes, all clear. Kaushiki is confirmed. What about the others? Viraj, Purnima, Akash, Namrata, Janvi, all clear. Kaushiki, all clear. No doubts. Okay, fine. Great. So this takes care of derivatives and own use exemption as well. So typically when we do a net settlement, you can say that those are of a speculative nature. Okay. Now there may be some of you, when you revise, you will say that, sir, own use exemption contracts mein, I have a right to purchase 100 tons of wheat. So if I have a contract to purchase 100 tons of wheat, or in our example, 10 grams of gold for 55,000, obviously you will have a doubt that, sir, I have an obligation to pay 55,000. No, see, look at the contract. It could be obligation, sorry, contract to receive 10 grams of gold for rupees 55,000. So now I will explain that. Okay. So now, don't you think that 55,000 should be a financial liability? What do you think? Should you consider 55,000 as a financial liability? Because as per the terms of the contract, I have a contractual right to receive 10 grams of gold, and for that I have an obligation to pay 55,000. So now I just am building up on that example so that once and for all we are clear about own use exemptions. Yes. So we have an answer where it says that it appears to be a financial liability. What about the others? Janvi, Namrata, do you think that I have a contract to receive 10 grams of gold for rupees 55,000? So I will get 10 grams. In return, I have to pay 55,000. So now tell me, don't you think 55,000 should be a financial liability? Not necessary. Janvi, you cannot say that it is not a contract to obtain financial asset. Suppose you are what you say, you are an entity, you are a business entity. Okay, we had discussed in our examples, in our kahan gaya my examples, trade payables, financial liabilities. Do we include trade payables? Obviously yes. Yeah, trade payables means what? Purchase of raw materials, purchase of goods, purchase of what you can say services. All these come under trade payables. What I'm getting is a non-financial asset. Goods. Goods are not financial assets, but I have an obligation to deliver cash by virtue of that. Why do I have obligation to deliver cash? That is how the trade terms are. Today I procure goods. In return, I have to pay the amount for that after say 1 month or 2 months as the case may be. And therefore, trade payables are financial liabilities, irrespective of the fact that what we are getting are non-financial assets. So therefore, in this case, don't you think that contract to receive 10 grams of gold for 55,000 means that it is a financial liability? Answer is no, it doesn't. Sir, ये तो गोल गोल घुमा रहे हो, ये तो गोल गोल घुमा रहे हो. Okay, let us understand. When does trade payables come into play? When does trade payables come into play? Trade payable, you will account for a liability when you receive the material. When you receive the material, आपके पास material आता है, उसके बाद you book the invoice and then the trade payable sits in your balance sheet as a payable. So it is an executed contract. It is what? It is an executed, executed, a contract which has already been executed by the counterparty. He has fulfilled his obligation by delivering the goods to you, and therefore you have an obligation to deliver cash to him. That is why trade payables becomes a financial liability. However, in this case, it is a contract to receive 10 grams of gold. You haven't received it. Look at the words. It is a contract to receive. How can you book a liability without receiving the gold in the first place? How are you going to book a liability? See, trade payables entry क्या होता है? Purchases account debit to trade payables. Am I right? So when you pass this entry, all of you have done articleship or are doing articleship. When do you book this entry? Purchases account debit to trade payables. Once the goods are received, once the GRN is done, inspection is done, that time you book the entry purchases account debit to trade payables. That means what? You receive the asset and then you book an obligation. However, in this case, have you received the asset today? No, you are entering into a contract today to receive the asset on a future date. All these are derivatives. All these are derivatives. Derivatives means settlement happens at a future date, not right now. And therefore, the settlement happens at a future date means what? None of the parties have fulfilled the obligations that they have today. You have not received the gold. And if you have not received the gold, चलिए आपका बात मान लेते हैं. I will record a payable here. I will record a payable here. Okay. What am I going to book as receivable? What am I going to book at receipt? कुछ नहीं book कर सकता मैं. None of the parties have performed their obligations. This is going against the principles because I will have an obligation only when a corresponding asset is there. There is no corresponding asset and therefore I cannot create this obligation. And therefore these own use exemption contracts are also known as, in this case only, executory contracts. कौन सा contracts? Executory contracts. They are yet to be executed. They are yet to be executed. Okay. Suppose, what you say, you hire an employee. The moment you hire an employee, will salary be payable to him? Answer is no. As and when he starts working for you, salary starts getting accrued. On the date of hiring itself, you will say that 1 month salary has accrued, 10 months has accrued, 1 year has accrued. Can you say that? No, you cannot. You go to perform an audit service. Will the audit bill be booked on the date of engagement itself? Answer is no. Audit bill will be booked when the audit is performed and the audit report is submitted to you. You'll make a provision. No doubt about it. You will make a provision, but the contract will be deemed to have been executed only when the audit report is signed and given to you. And therefore, own use exemption contracts cannot have a financial liability obligation because the contracts have not been executed in the first place. Is it okay? That is why they do not fall under the ambit of financial liability. If one party fulfills the obligation, then the counterparty has an obligation to pay the cash. So in our example, if Tanishq delivers gold on that particular day, and for some reasons you could not pay the cash, then you now have a financial obligation to deliver 55,000 rupees cash. Okay, you now have the obligation. Is it okay? Have you understood? Yes or no? Has everyone understood? If contract is already exercised, I won't say exercise, contract is already executed. Okay. One of the parties should execute. Only then it will be a contractual obligation. See, you have entities like where you enter into large open purchase orders. Okay. Suppose I am manufacturing something that requires say plastic granules. So I need plastic granules on a long-term basis. Okay. I need plastic granules on a long-term basis. And that is why what will happen is, I make a purchase order saying that I need 10,000 tons of plastic granules in the coming financial year. Do you think 10,000 tons will be delivered to you at one point of time? Answer is no. धीरे धीरे करके आज 100 tons, next week में another 2,000 tons, then another 50 tons. ऐसे एक एक करते करते he will go on delivering the goods to you. Will you record the liability for 10,000 tons right now on the first day when you execute the purchase order? Can you do that? नहीं कर सकते आप ऐसे. You cannot do that because this is just an order so that your supplier will set aside the supplies for you. It is to help him in the planning of his process. At the same time, it is to ensure that you do not fall short of material at any point of time. And therefore, this is just an indication that these are the materials I will need. Basis your purchase order, आप liability कभी book कर ही नहीं सकते. The contract is still executory. Out of both the parties, one of them should have fulfilled the obligation. So therefore, it then becomes obligatory on the other party to fulfill his or her obligation. Is it okay? तो उसको हम लोग बोलते हैं executory contracts, which will not fall under financial liabilities. Is it okay? Yes. Sure. Absolutely sure. Yes. Namrata, all clear. Janvi, all clear. Yes. Yes. Anybody has any doubts? Yes. For own use contract, we have to see whether not both one of the parties executed. If either of them not executed, not a financial instrument. No. One of them execute. See, both executed means what? Then the contract is honored. You buy, you get the gold and you pay the obligation. Then there is no obligation on your head. You are having the gold in your hand. Tanish got the cash. Now there is no contractual obligation. For a financial asset or a financial liability or for any asset or liability, when can you book it here? Come on. You can book if one party has fulfilled the obligation in the contract, the other party is yet to fulfill it. Hey, come on, this is too basic. Okay. Any contract, receivable payable कब होगा? जब सामने वाला अपना काम करेगा. Okay. Until then you cannot. When you say revenue received in advance, when the opposite party has paid the cash to you already, that time you call it as revenue received in advance. Okay, you are yet to deliver the services. तो उसको हम लोग बोलते हैं revenue in advance because the other party has fulfilled his contractual obligation to pay the cash to you. That's it. Now for you, it becomes incumbent to pay to what you can say, to give the revenue. So that is how it is. So you can book assets or liabilities only when one of the parties fulfills and the other party is yet to fulfill. Okay, तो उसको हम लोग बोलते हैं execute partially executed contracts. Contracts which are fully executed, both the parties have fulfilled their obligations. तो अब entry किस बात का? Entries would already have been entered in your financial statements. There won't be any payable receivable left. Okay. All right, fine. So that takes care of this. Okay. Now coming back to our discussions. Okay. Yes. Okay. If you come to your study material, there is a section on own use exemptions. Okay, I'm just seeing that. Okay, contracts to buy or sell non-financial items, that is own use exemptions. Okay, see, contracts to buy or sell non-financial items outside the scope of financial instruments, outside the scope of financial instruments, except for the following. Except for the following. Contracts to buy or sell that can be settled net in cash or other financial instruments. I told you, net settled commodity derivative contracts are going to be financial instruments, which is what they are saying. Only thing is the language used is a little lengthy. Okay, so they are saying own use exemption contracts are outside the scope, except for contracts that can be net settled in cash or other financial instruments. Is it okay? So this is what we have already discussed. Okay, so you can go through this later on. What all we have discussed, we have already explained to you. Okay, so then a contract to buy that can be net settled in cash or other financial instrument. Don't read a lot of things because many things are yet to be discussed. Okay, like irrevocably designated as measured at FVTPL. All these terms will come in the future classes. But as of now, what we have discussed is there here under this section in the study module. Okay. Now, okay. This part is important. Okay. There are various ways in which a contract to buy or sell non-financial items can be settled net in cash or another financial instrument or by exchanging financial instruments. So basically, this paragraph is talking about types of net settlement. I gave you one example of net settlement. Okay, I gave you one example of net settlement. That means instead of me paying 55 and Tanish giving me the gold, I will tell Tanish, you just pay me 6,000 rupees and we are net settled. We are good to go. Okay. So that is the first case where terms of the contract permit either party to settle it net in cash or other financial instruments or by exchanging financial instruments. Okay. So this is the first one. This is the example which we discussed. Okay. When the ability to settle the contract net in cash, ability is not explicit. Okay, it's not mentioned in the contract, but the entity has a practice of settling similar contracts net in cash. So therefore, what we have to look is not only whether the contract permits, but it may be possible that the contract is silent on net settlement. However, you have a practice of doing net settlement regularly on such contracts. If that is the case, then you can say that the contract is a net settled commodity derivative contract. Okay. And the third case is for similar contracts, entity has a practice. You take the delivery and sell it within a short period after delivery for the purposes of generating a profit from short-term fluctuations in price. Okay. So for similar contracts, the entity has a practice of taking delivery and selling it within a short period after delivery for the purpose of generating profits. So therefore, own use exemptions, net settlements, you cover this also. And last one is when the non-financial item is the subject of a contract, is the subject is readily convertible to cash, is readily convertible to cash. So net settlement has all the 4 features that we have already you have to understand. It need not necessarily be the 6,000 net settlement. It could also be based on past practice. It could also be based on taking the delivery and selling it within a short span to take advantages of price fluctuations. And at the same time, it could also be a contract that is it could also be an item that is readily convertible to cash. Is it okay? Are you absolutely clear about own use exemptions? Yes. Net settlement, types of net settlement, are you absolutely clear? Yes. Any doubt so far, anyone? Anybody, any doubts? Namrata, Janvi, any doubts? Yes. Yes, yes. C and D will be financial instruments because they are net settled. Okay. Although we take exemptions, we take the delivery and sell it off immediately. In spite of that, they would be net settled because the term C, contracts to buy or sell financial and non-financial items, to buy or sell non-financial items are outside the scope except for the following. Contract that could be settled net in cash. Okay. Contracts that could be settled net in cash and own use exemption, ka exemption, and it is a financial asset. Okay. If we pay cash before we get the gold, what will be the impact? That means you want to say you pay it advance. Okay. So what will be the impact? Just imagine with journal entries, it will be very simple. Okay. So you are paying advance to Tanishq, debit to bank. Okay. 55,000. Now, money has gone out of your bank. So therefore, ये तो bank account credit हो जाएगा. Bank account anyways is a financial asset. Bank account anyways is a financial asset. Advance to Tanishq, you will have to check whether it is a financial asset. What are you going to get against this advance? Are you going to get cash? No, you are going to get gold. So is it a financial asset? Answer is no. And therefore, that's it. This is no longer covered under financial assets. It is a regular asset. It is a regular asset. Okay. See, don't get confused that financial asset nahi hai, to asset nahi hai. Okay. Don't get confused. Many students, what happens is they think that if it is not a financial asset, it is not an asset at all. Arey, aise kaise ho sakta hai? You have non-financial assets also. So therefore, it is possible that this is an asset. No doubt it is an asset. Only thing is it is not a financial asset because against this advance, you are going to get gold. Gold is a non-financial asset. So you have a contractual right to receive a non-financial asset and therefore it is outside the definition of financial assets. Is it okay? Yes, sure. Any doubts? Any questions? Any questions that you have so far in this part? Yes. Bolo, please bolo. So basically the net settlement scope is very, very wide. Okay. It's a very wide scope and it covers a lot of options. So it depends on a case to case basis. Okay. Okay. All right. Jahnavi, are you clear, beta? Yes. Shriram, all clear. He has confirmed. Kaushiki, all cleared? Yes. Namrata, your query is addressed. Before we get the gold, what shall be the impact? That is done. And even for Tanishq, you have received money in advance, means it is like revenue received in advance. You have an obligation to deliver gold. Obligation to deliver gold is not a financial liability. Okay, it is a liability, but not a financial liability. Okay, all right. Fine. Unbilled or unearned revenue is not a financial liability. I think I have not crossed the amounts, the discussions, and therefore, see, unbilled or unearned revenue, it is not a financial liability. I had discussed it. Okay. Yeah, it was discussed. All right. Fine. आगे बढ़ सकते हैं. Yes. Okay, fine. Let us proceed now. Let us now proceed. Let us now come to, see, as of now, whatever I teach, it may appear to be disconnected. Suddenly I start derivatives. Suddenly now I'll be starting convertible debentures. Okay. Then I will do something else. But all this information, I am doing it only so that we understand the definition that is there, only so that we understand the definitions which are there in. We are still, I hope you understand, we are still discussing the definition of financial assets and financial liabilities. हमने और कुछ किया ही नहीं है. We are still in the first 3 clauses only. That is financial asset, financial liability, and equity. You need to be, I mean, this should be a part of you. Okay. You should breathe these definitions. That is how you should get the clarity. Only then you can move ahead with the later part of these standards. Okay. So now coming to debentures. Okay. Coming to debentures or preference shares. कुछ भी नाम बोलो. So what is the important part you have to see is the names do not really matter now. The names do not really matter. What matters is the features. What matters is the features of the instrument. Okay. You look at the features, you identify whether it is a financial asset or a financial liability or a non-financial asset or a non-financial liability. Okay. So now coming to debentures or preference shares. Okay. If you have purchased them, if you have purchased, that means you have invested in debentures, invested in preference shares. Obviously, these become financial assets. These become financial assets. Okay. Equity which is issued goes under equity share, under equity. Equity of another entity which is purchased becomes a financial asset, becomes a financial asset. Okay. But now there could be certain complex or what you can say mixed instruments. Like for example, you take any debentures or any preference shares. What would be the 2 streams of cash flows? Okay. We look at convertible part later on. What could be the 2 streams of outflows? Okay. I'm talking from the perspective of the issuer. Okay. So now you look at the cash flows. One is the distribution and one is the redemption. There are 2 flows. One is distribution. That means you pay off the interest or you pay off the preference dividend. And the second one is redemption of the principal amount. Redemption of the principal amount. Okay. So you could have a case where distribution ends up being mandatory. Mandatory means what? It is compulsory that you pay the cash towards distribution. हर साल आपको देना पड़ेगा, ऐसा आपका डिबेंचर कॉन्ट्रैक्ट में लिखा है. It is mentioned in the contract that these debentures you will pay 8% rate of interest. नाम पे ध्यान मत दो, फीचर्स पे ध्यान दो. Don't look at the name, look at the features. Okay. Mandatory outflow towards interest oblique preference dividend. You tell me whether this stream of payments, is it giving rise to a financial liability? Don't look at debenture preference share as one instrument. Split it up. What are the features of this instrument? There could be distribution there could be redemption. Now I'm talking only about distribution. That means payment of interest or payment of dividends. If this is mandatory, हर साल देना पड़ेगा हमको, we have to pay it every time. Sir, preference dividend है ना यार? You people have studied cumulative preference shares. Cumulative means what? If you don't pay, it goes on getting accumulated. That means, is it a mandatory payment which you are doing? Answer is yes, you are doing a mandatory payment. And if it is a mandatory payment, is it meeting the definition of the obligation to deliver cash? Yes, it is. And therefore, it becomes a financial liability. What becomes a financial liability? The stream of distributions that you are making. I am not yet talking about the instrument at all. मैंने अभी तक इंस्ट्रूमेंट एज अ होल बात नहीं किया है. इंस्ट्रूमेंट में डिस्ट्रीब्यूशन, ओके, दैट मींस पेमेंट ऑफ इंटरेस्ट is mandatory, payment of preference dividend is cumulative, is mandatory. So this distribution of it becomes a financial liability, as everyone rightly said. Distribution becomes a financial liability. Acha, when I say financial liability, there should be an obligation to deliver cash. Many times you have loans that come with variable rates of interest or floating rates of interest. Sir, like for example, it could be a stream of flows where the interest is RBI rate plus 4%, MCLR plus 2.25%, or LIBOR plus 1%. So as the base rate changes, as the RBI rate changes, as the marginal cost of lending rate changes, as these rates go on changing, your interest also goes on changing. But what is the underlying fact? वो तो सिर्फ rate है ना यार. That is only the rate. Underlying fact is, based on that rate, what interest has accrued, that has to be paid in cash. And if that has to be paid in cash, will it be a financial liability? Answer is yes. The important point is, do you have a discretion at this stage to avoid payment of interest? Answer is no. That interest may be fixed. That interest may be linked to RBI rate. That interest may be linked to Mumbai Interbank offer rate. That interest may be linked to London Interbank offer rate. That interest, whatever be the manner of determination of interest, whether it is fixed, whether it is variable, the fact is that interest oblique preference dividend has to be paid in cash, and therefore the stream of payments towards distribution is a financial liability. Okay, interest / preference dividend could be fixed or variable. I'll come to your question, Sriram. Okay, interest / preference dividend could be fixed or variable. But if the stream of distribution is to be paid in cash, it is a financial liability. It is a financial liability means, what is a financial liability? Not the debentures. I haven't analyzed the debentures yet. I am only analyzing that the distribution is a financial liability. Okay, distribution is a financial liability. That's it. Redemption पे तो बात आया नहीं है. What you used to do in intermediate is, डिबेंचर नाम लिखा है ना, वो भले कुछ भी हो जाए उसके साथ, इवन इफ इट इज कंपल्सरीली कन्वर्टेबल, आप क्या करते थे? व्हाट यू यूज्ड टू डू, धाड़ करके यू यूज्ड टू पुट इट इन फाइनेंशियल लायबिलिटीज. यस, नॉन करंट लायबिलिटीज, because that was what was required. It was more of a legal form accounting. Here we are not looking at the legal form. We are looking at the substance of the instrument. And that is why each and every flow of cash matters. Each and every clause in the contract matters. Okay, so you have to be double, triple careful to see, because right now there are huge number of exotic instruments in the market. Okay, with the coming of startups, with the coming of these fresh instruments, you have to read the contract to see by ki cash flows what are there, what is mandatory for it to become a financial liability, or whether it will be an equity. Okay, now let us move on. If the distribution is not mandatory, if it is discretionary, if it is discretionary, if it is discretionary, discretionary means what? Nobody has put an obligation on the company. So do you have a contractual obligation to deliver interest? Answer is no. Do you have a contractual obligation to pay the dividend? Again, the answer is no. And if there is no obligation to pay the interest or to pay the dividend, then you don't have a contractual obligation. So will it be a financial liability? Answer is no. In such a case, the distribution portion ends up being equity, So what is important is discretion. Discretion decides the classification. Discretion decides the classification. So it will not be a financial liability. It ends up being an equity. It ends up being equity. Is it okay? Yes. All clear so far? Fine. Redemption. I have not yet gone to conversions. Okay. I have not yet gone to convertible instruments. Redemptions. Redeemable. Redeemable. Okay. Now, when you talk about mandatory redemption, what do you think? Is this redemption means you have to pay it in cash. Okay. So redeemable. When you talk about mandatory redemption, what do you think? Yes, redeemable. What do you think? Is there a contractual obligation to pay the principal amount? Is there a contractual obligation to pay the principal amount? Yes, there is a contractual obligation. And because there is a contractual obligation, so here contractual obligation to pay principal in cash. Cash means bank. Okay. I mean, don't think that cash means it's hard cash. Okay. So this ends up being a financial liability. This ends up being a financial liability. This is discretion of the issuer. Okay. Discretion of the issuer. होल्डर का क्या डिस्क्रिप्शन? होल्डर तो बेचारा संत आदमी है, वो जो मिला है वो बेचारा लेगा. ओके. सो होल्डर के पास कोई, he has the option to invest in these instruments or not to invest. Okay. So holder, right now, holder to bechara, no option. Okay. All right. Fine. I'll come to discretionary. Okay. You do not have irredeemable instruments in India. वो बात याद रखो. Even preference shares, maximum maturity is 20 years. After 20 years, you have to redeem it. Okay. So that is what Companies Act states. And therefore, please don't say that we are not studying Companies Act here. Okay. So there are instruments which are irredeemable. Okay. They only give interest. Principal कभी आपके पास आएगा ही नहीं. Okay, who issues, who subscribes, I'm not interested. I am interested in looking at the feature of the instrument. That's it. Okay, why will anybody subscribe? Uska marzi hai yaar. Usko, he wants an income annuity flow regularly. So he puts the amount and then he goes on getting the flow of distributions. So why are you worried about it? Okay, you look at the classification. That's it. If it is irredeemable, do you have a contractual obligation to deliver cash? Answer is no. No contractual obligation to pay principal in cash. No contractual obligation to pay the principal in cash. So if there is no contractual obligation, what are you going to classify it as? Sir, you will classify it as equity. You will classify it as equity. Okay. So now I could have an instrument with any of these combinations. I could have an instrument with any of these combinations. Sir, what do you mean any of these combinations? I could have an instrument which could be mandatory distribution and redeemable. If that is the case, whatever be the name, naam kuch bhi ho, you call it preference shares, but those preference shares come with mandatory distribution and are redeemable. Then the distribution also is a financial liability. The principal also is a financial liability. The principal also is a financial liability. And therefore, the entire instrument becomes a financial liability, what I call as a pure financial liability. Okay. When is it a pure financial liability? When distribution plus redemption, both of them are financial liabilities. That means there is an obligation to distribute and there is an obligation to redeem. So in both of these cases, if both of them are financial liabilities, then it becomes a pure financial liability. It becomes a pure financial liability. Now we come to the next set of instrument, that is it is a very, very interesting chapter. Okay. You look at an instrument with discretionary dividends and irredeemable principal. You look at an instrument with discretionary dividends and irredeemable principal. So what does it mean? I had lot of queries that spoke about discretion. Okay, that spoke about discretion. What is discretion? See, today I give, okay, suppose you have purchased the shares of Reliance Industries. Suppose you have purchased the shares of Reliance Industries. Year is done, very profitable, dividend is not declared. Next year comes, very profitable, dividend is not declared. Third year comes, very profitable, again dividend is not declared. Aap frustrate ho gaye. You got frustrated. And what you did, you went and sued Reliance Industries. ये कंपनी मेरे को डिविडेंड ही नहीं दे रहा है. This company is not issuing dividend at all. Tell me one thing. Will you win that suit? Will you win that case which you have filed at Reliance for not declaring dividend? Will you win that case? Tell me. You have knowledge of the Companies Act. Reliance did not pay dividend for 3 continuous years. आप डिविडेंड के आशा से रिलायंस में पैसे डाले, डिविडेंड आपको मिला नहीं. You file a case against Reliance. Will you win it? Answer is no. Dividend becomes a liability if the directors declare and the shareholders approve. Are you aware, right? Dividends become a liability if the directors propose to declare, shareholders approve it, then it ends up being a liability. Then within 7 days, transfer the money to a separate bank account. From there, you credit it. And therefore, we are not going to win such a case. Okay. The dividends are always at the discretion of the entity that issues it. Okay. That issues it. However, once it is declared, And once it is approved by the shareholders, then yes, the dividend which was till now discretionary, that particular dividend ends up being a liability. You have to make the payment. You have to make the payment. Okay. So this is known as a discretionary distribution. This is known as a discretionary distribution. Is it okay? Yes. Have you understood discretionary? Discretionary means at the option. Okay, it's optional. It's not mandatory. Nobody can sue you if you don't declare dividend. Okay, nobody can sue you if you don't declare dividend. Is it okay? Yes. So therefore, discretionary. Now, suppose I have an instrument with distributions being discretionary and principal being irredeemable. Understand the instrument very carefully. Understand the instrument very carefully. I have an instrument with discretionary distributions plus irredeemable principal. I have an instrument with discretionary distribution, irredeemable principal, and the name of this instrument is debentures. Okay, the name of this instrument is debentures, but the interest on these debentures is discretionary as per the terms of the contract, and the principal is never going to be redeemed. So what are you going to classify it as? It is a pure equity. It is a pure equity. Is it okay? It is a pure equity. Okay. So please don't look at the names. Please look at the contractual cash flows that will happen. That is going to be the guiding principle for identifying whether an instrument is equity or liability, or a financial liability, or even a financial asset for that matter. Okay. I am right now thinking from the perspective of the issuer only. This case is from the perspective of the issuer. Okay. All right. Fine. अच्छा, यही केस में, in this own case, holder के केस में क्या होगा? Suppose I have purchased this debenture where the distribution is discretionary, where the principal is irredeemable. आई बात समझ में? I have purchased this instrument where distribution is discretionary and the principal is irredeemable. How will I classify it? I have invested in this instrument. Okay. I have purchased this instrument. How will I classify it? How will I classify the holder? Issuer ke case mein everybody said it is equity. Absolutely fine. I give a thumbs up to you. Yes. Yes. For me, this is going to be a financial asset. For the holder, this instrument will end up being a financial asset. Look at the definition. A financial asset is cash or equity instruments of another entity. It is not saying equity shares. Please mark my words. Definitions may nowhere it is written that it is going to be equity share or bond or debenture, ye, wo. Nothing is written. It is purely based on the characteristic of cash flows or characteristics of equity issues, which I'm going to come today. So therefore, for me as a holder, I have invested in an instrument which is exhibiting equity characteristics, Okay. So therefore, it becomes a financial asset for the holder. Okay. Pure equity means the irredeemable debentures will be deemed to form part of share capital. Not share capital, this will go and sit under other equity. Equity ke head mein it will go and sit under other equity. Okay. So share capital will obviously have equity shares. Okay. That's it. Then after that, preference shares, debentures which are irredeemable, all these instruments will go and sit under other equity because they have the features of equity, but they are not equity shares. Okay, so I have to look at Companies Act also, unfortunately. So equity shares means instruments that typically would be having some voting rights. Okay, so that is only share capital. So therefore, with voting rights, differential voting rights, etc. But this standard never talks about voting rights. This standard talks about only the characteristics. Okay. All right. Now, Namrata has a question. Namrata, which question you gave me? See that advance paid for gold. I told you what it is. It is advance for gold account debit to bank. Advance for gold, you are going to get gold against the amount paid, and therefore it is not a financial asset. Apart from that, you had asked anything else? It is a crucial part, financial liability obligation. Yes, this is discretion of the holder, this discretion of the issuer, distribution. Okay, distribution is at the discretion of the issuer. Okay, so that is done. Shriram had a question. If a person pays money for purchase, Namrata, just tell me which question you want me to refer. Okay, I'll just have a look at that. For equity shares, if a person pays money for purchase of equity shares. Okay, amount received is a financial. Okay, so if a person pays money for purchase of equity shares, so I will pass the entry cash bank account debit. So cash bank account debit means it is cash. Cash is a financial asset. So it becomes a financial asset for me. And now he is obligated to issue the equity shares. So now the question is whether this is a financial liability. So now we'll come to that. It is going to be equity only. Why it will be equity? We have one part left, that is fixed for fixed. So I am going to discuss that, then that will be clear for you. Okay. Yes. So now coming back to our discussion, suppose I have an instrument. I have an instrument with discretionary distribution plus mandatory redemption. I have an instrument with discretionary distribution. Matlab, it is preference shares which are non-cumulative. Non-cumulative preference shares. You would have studied it in your intermediate. Preference shares are of two types. They could be cumulative, they could be non-cumulative. Cumulative means dividend goes on accumulating every year. When you want to declare the dividend for a particular year, all the previous year's dividends have to be paid off. Non-cumulative means dividend does not accumulate. When the company wants to declare, that time it is going to pay off the dividends. Okay, so here it is discretionary distribution plus mandatory redemption. This becomes neither a pure equity nor a pure liability, financial liability. This becomes a compound financial instrument. This becomes a compound financial instrument. Why compound? Because the distribution streams exhibit equity features, whereas the redemption exhibits liability features. And therefore, it becomes a combination of both, and therefore it becomes a compound financial instrument. And for compound financial instruments, we will have to split it between the equity component and the liability component. वो कैसे करेंगे वो बाद की बात है. Right now, compound financial instruments means you may have received 1 lakh in the bank account for these instruments, but the 1 lakh is a representative of a distribution stream which is in the nature of equity, and a stream of redemption, the payment of principal, which is in the nature of liability. So that 1 lakh has to be split between equity component and the liability component. वो कैसे करेंगे, how to do the accounting, उसके ऊपर there are a lot of problems. We will be discussing that. Okay. If payment of interest or dividend depends upon the amount of profit earned by the entity, then what will be the impact? See, it ends up being, what you have to understand is how is the contract determined? Okay. When you talk about payments being dependent on the profitability, then you have to see whether if there is a loss, are you paying something? If there is a profit, are you paying something? If there is a bumper profit, are you paying a higher amount? If there are super profits, are you paying a very high amount? If this is the case, then it is a discretionary flow, because you've not paid anything when you made losses. You are paying when you are making profits, bumper profits. So these end up being discretionary. And therefore, it is exhibiting equity characteristics, because equity holders are getting money when the company ends up making profit. And when the company ends up with losses, there is no payment flowing to them. Yes or no? So they are equally taking risk depending on the profitability of the entity. So it becomes an equity characteristic. Okay. So that is how you will be recording. So the equity component, coming back to our discussion, the equity component in our example of compound financial instrument will be shown under other equity. Is it okay? Yes. Is it fine? All right. So you could have pure financial liability where distribution is mandatory, redemption is mandatory. Pure equity where discretionary is, where distribution is discretionary, where the redemption is irredeemable. So therefore it becomes pure equity. Or you could have a CFI, or you could have a compound financial instruments where either discretionary dividends with a mandatory redemption, or mandatory distribution with irredeemable principal. This also becomes a CFI. This also becomes a compound financial instrument. Any of these things, any of these combinations can be there in your instrument. Okay. So that takes care of it. Okay, that takes care of it. So any of these combinations. There is one more feature to debentures which is attached, and that is your conversion feature. We are going to discuss that after we do the next discussion that I'm going to take right now. Have you understood this part? Are you guys noting it down, or do you want to note it down? Yes. Do you want to note it down? Then let me know. I'll just keep it, or you can take a screenshot and proceed. Okay. Are you liking it? It's becoming too much of theory, or am I able to effectively reach out to you? Tell me. Are you finding the sessions boring, or any improvement is required? Please let me know. Okay. All right. Fine. Let us now move on to the next part. बात करेंगे किस part का? So let us understand that we are still in the definition part. Hey Bhagwan. Now we are going to discuss this. This part. I have discussed obligation to deliver cash, another financial asset, options I have discussed, and now we are going to discuss this. And with that, not this. the definition of liability comes to a close. Same clauses are there in equity also. So equity also comes to a close. Okay. So now let us take an example. Okay. Let us take an example. I am discussing financial liability definition. See, I have to take examples because if I read it from there, कुछ पल्ले नहीं पड़ने वाला. Okay. B2. I am discussing B1 right now. B1. Okay. So now suppose I have entered into a contract buying goods or property, plant, equipment. Settlement in own equity. Settlement in own equity. Okay. So now I'll give a break. Let me just complete this. Okay. मेरे को definition complete करने दो. Okay. I'll give a break because if I give a break now, the flow will go away. Okay. I buy goods and the settlement happens in own equity. The settlement happens in own equity. एक तरह से देखो तो I am issuing equity instruments to pay a liability. Okay. Understand this right now. Will it be liability? Will it be equity? अब भी just discuss करेंगे. But as of now, just understand that I am purchasing goods. In return, I am issuing equity shares. So equity shares एक तरीके से currency हो गया. My equity shares in some way represents currency. Okay. It is a mode of exchange. Currency, what does currency do? It exchanges goods or services. So I am issuing my own equity shares. That is what it is. Okay. So now let us take the case of A Limited. A Limited has a vendor. Okay. It has purchased goods or property, plant, equipment, whatever it is. Okay. Now, goods or property, plant and equipment, whatever it is, worth rupees 5 lakhs. Worth rupees 5 lakhs means invoice pay. On the invoice, the taxable value of these goods or property, plant, equipment is 5 lakh rupees. In return, what will be paid is there is a 2 months credit. 2-month credit. Now against the 2 months credit, the supplier, the vendor has also agreed and A Limited also is going to issue shares. A Limited also is going to issue shares. Okay, fine. Now, you have entered into this contract on, let us say, 1st March. You have entered into this contract on, let us say, 1st March. On 31st May, the issue of equity shares is going to happen. The issue of equity shares is going to happen. Okay. Now, suppose today's date on 1st March, the market price is rupees 100 per share. Suppose the market price is rupees 100 per share. Now, the question is, the number of shares to be issued is 5 lakhs divided by rupees 100. So that comes to 50,000 shares. Okay. Did you understand the case? Yes. A Limited purchased goods or machinery worth 5 lakhs on 1st of March. The payment is going to be made after 2 months in the form of equity shares. Okay. How many shares to be issued? Sir, you will tell the 1st March ko the price is 100. So therefore, you will be issuing 50,000 shares after 2 months. Agreed. तो बात क्या हो गया? 50,000 shares, rupees 100 per share market price, the shares will be issued. The shares will be issued. वो supplier भी चला गया and A Limited also went. Both of them were happy that they are getting. Sorry, 5,000 shares. That's right. Thank you. 5,000 shares. 5,000 shares. Okay. So 5,000 shares have to be issued. Today the market price is 100. So आज के तारीख में when I received the goods, I told them I will give you 5,000 shares after 2 months. Now, tell me one thing. If price of shares falls, if price of shares reduces on the date of issue, 31st May, on the date of issue, suppose the price is rupees 10. Suppose the price is rupees 10. The vendor cannot come to A Limited and say, your share is only 10 rupees. Now you give me 50,000 shares. नहीं मांग सकता वो. Because this is a contract where you have agreed to issue 5,000 shares for a value of 1,000, for a value of 100 rupees per share. It is already decided. It is already decided on 1st of March that you will be issuing 5,000 shares at 100 per share. Abhi price ho gaya 10 rupees. A Limited will say it's none of my fault. You agreed to this based on the prices prevailing on 1st of March, and therefore I am going to issue you 5,000 shares at 100 per share only. Nothing else. Okay. Sir, opposite bhi ho sakta hai. Kya ho sakta hai? If price of shares increases. Suppose the share price reaches rupees 500. Suppose the share price reaches rupees 500. Do you think that on 31st May, do you think A Limited will go to the vendor and say, look, my share price has gone up from 100 to 500. And because it has gone up from 100 to 500, I will not issue 5,000 shares. I will issue you only 1,000 shares because it is after all 5 lakh rupees ka liability. Do you think the vendor will agree to that? Answer is no. वो बोलेगा I agreed to equity shares only because of this reason, because you are such a good performing company. So therefore, I am not going to accept 1,000 shares. As per the contract, you will issue me 5,000 shares only at 100 rupees per share, the value which was determined initially. Is it okay? So on 31st of May, jo jayega, that will be 5,000 shares only. Now I want you to think and answer. Now I want you to think and answer. The vendor in this case, from which date he is subjected to risk? Is he subjected to risk from 1st March itself? Because 1st March se leke 31st May, whatever price fluctuations are happening, will the vendor himself be responsible for that, or can he claim a compensation from A Limited for that? Are you able to follow? They have entered into a contract for issue of 5,000 shares at rupees 100 per share. For issue of 5,000 shares at rupees 100 per share, and therefore the vendor is immediately subjected to the price risks in equity right from 1st March itself. Right from 1st March itself, the vendor is subjected to the risks. Acha, is A Limited subjected to the risk? Answer is no. A Limited के पास क्या risk है? Okay, A Limited has no risk because उसको सिर्फ 5,000 shares issue करना है. So therefore, when the vendor is subjected to the risk, when the vendor is subjected to the risk, you tell me this risk which he is subjected to, is it the risk that is there for a normal vendor, or is he subjected to the risk of an equity shareholder? So I am asking about nature of risk. I am asking about nature of risk. Is the risk that the vendor is subjected to, is that risk in the nature of a regular vendor, or is the risk in the nature of an equity holder? What is the risk that you are able to envisage? Sir, regular vendor का risk है ही नहीं. What do you mean by regular vendor? Risk of non-payment. That is the only risk which a vendor will worry about. Here, he doesn't have to worry about that. क्यों? Because A Limited will always be able to issue shares. उसमें क्या है यार? Share certificate निकालो, print करो, give number to the shares and issue it to the vendor. So there is no risk of payment. The risk is in the fluctuation of the prices. The risk is in the fluctuation of the prices. And if the risk is in the fluctuation of the prices, can I say that the obligation which is being settled by issue of equity shares, the obligations which are being settled in the manner of equity shares is making the vendor not a vendor but an equity holder? Can I say that by virtue of this contract, my vendor is subjected to the risk which is at par with that of an equity holder? So can I say that my vendor is now no longer a vendor, but he is an equity holder? And if he is an equity holder, can I say that A Limited has no obligation at all? What A Limited is issuing is basically equity. I'm not saying shares. Please beware. I'm not saying shares. I'm saying the instruments which he is issuing is equity in nature. Is ultimately jayega equity share. See, I'm immediately changing the question in the alternative to this. But right now, can I say that the instruments being issued are equity in nature? Yes. So therefore, number is fixed, price is fixed, What is the nature of instruments being issued? Sir, this is going to be in the nature of equity. This is going to be in the nature of equity. Okay. Now, let us rotate this question. Rotate this question means what? Vendor को पता चल गया, ये यार प्रॉब्लम हो सकता है. Vendor को पता चल गया कि this problem can happen. कौन सा प्रॉब्लम? प्राइस फ्लक्चुएशन कभी भी हो सकता है. सो व्हाट द वेंडर टेल्स इज, लुक, आई नो दैट योर प्राइसेस कैन फ्लक्चुएट in any direction. I know that the prices can fluctuate in any direction. So what I will do is, I will accept the shares depending on the price which is prevailing on 31st May. मैं आपके बात में आके 1st March के प्राइसिंग पे शेयर्स एक्सेप्ट नहीं करूंगा. I will accept the shares depending on the price prevailing on 31st May. That means if the price is ₹10, if this is case 2, okay, if the price is ₹10, how many shares will be issued? Sir, 50,000 shares will be issued. If the price is ₹500, how many shares will be issued? Sir, if the price is ₹500, 1,000 shares will be issued. 1,000 shares, no? Correct. 1,000 shares will be issued. So now you tell me, is the risk of the vendor mitigated by this arrangement? The second case, is the risk mitigated by this arrangement? Yes. Is he getting 5 lakh rupees depending on the settlement prices? Yes. Is there a risk to his 5 lakh rupees? Is there a risk to his 5 lakh rupees? Answer is no. Because depending on the pricing of the shares on 31st May, the number of shares to be issued will change. The number of shares to be issued will change. So if the number of shares change, there is a variability in the number of shares depending on the pricing. So variable number of shares for variable pricing, the vendor is not subjected to any risk as an equity holder. He is getting a guarantee for his 5 lakhs. When he is getting a guarantee for his 5 lakhs, it means what? He is wanting to treat himself as a liability holder and not an equity shareholder. Are you able to follow? He is willing to treat himself as a liability holder only and not as an equity holder. तो वो बोलता है I don't want to be subjected to your price fluctuations. आपका प्राइस ऊपर नीचे हो, इससे मेरा क्या लेना देना? I have supplied you goods of 5 lakhs. You want to make payment in shares? Please make payment in shares. But number of shares, I am not deciding on 1st March. I will decide on 31st May, depending on your market price. And therefore, the vendor's risk appetite is not in the nature of an equity shareholder. It is in the nature of a liability. It is in the nature of a liability. And therefore, the risk lies with whom now? In the first case, the risk was with the vendor. In the second case, the risk is with A Limited. Sir, what is the risk? Risk could be that number of shares to be issued could be higher. If number of shares to be issued could be higher and lower, depending on the pricing, then the risk of settlement lies with A Limited. No, bhale hi wo equity shares issue kare, doesn't matter. He is not paying even 1 paisa of cash. That is also fine. But ultimately, the vendor wants to be treated as a liability. And therefore, if the vendor wants to be treated as a liability, is A Limited having discretion to settle, or is A Limited mandated to settle 5 lakhs? Understand the words. Is A Limited having the discretion to settle 5 lakhs, or is A Limited mandated to settle 5 lakhs? He is mandated to settle 5 lakhs. In the first case, A Limited had the obligation to deliver only the own equity shares. A Limited had the, I'm using obligation loosely, okay? He had the requirement to deliver the equity shares. That's it. But now he is required to deliver equity shares worth 5 lakhs. So therefore, though the instruments which are being issued are equity in nature, in reality, they are settling a liability. They are settling a liability. And therefore, in the second case, when number is variable, this ends up being a liability. This ends up being a liability. Have you guys understood this? Have you understood? So the first case, number of shares is fixed, price is fixed, then the risk is shifted on the vendor's head. The risk is there on the vendor's head. He removes the hat of a supplier, he puts on the hat of an equity holder, and he will be subjected to price fluctuations like every normal equity holder. And therefore it goes and sits in as an equity. But in the second case, the vendor does not want to remove the hat of a vendor. He wants to say, I need my 5 lakhs back. Kaise bhi do, you give me equity, whatever, depending on the pricing on 31st May. If the number is variable, it ends up being a liability. It ends up being a liability. Have you understood this part? Have you understood this part? And now we come back to the definition. And now we come back to our definition. And now we come back to the definition. I'll come to that. A contract that will means mandatory. Will means mandatory. Or may be settled. That means this is optional. That means options are also covered. In the entity's own equity instruments. In our example, A Limited settled the contract in his own equity instruments. So therefore, is this contract getting covered here? Yes. And is a non-derivative. Is it a non-derivative? Yes, because there is actual delivery of goods. There is actual delivery of what you can say of machinery. So there is actual delivery. Against that you are making the payment. So it is not a derivative contract. Derivative means there should be an underlying asset. यहाँ पे underlying क्या? Asset खुद चल के आ रहा है मेरे पास. And for that asset I am issuing my own shares, which by the way has its own value. The value of my shares is not dependent on any underlying. My share has its own value. That machinery or goods which are coming have their own value. So therefore it is a non-derivative contract for which the entity, in our example A Limited, is or may be, so mandatory or optional, obliged to deliver a variable number. In our example, the number moved from 1000 shares to 50,000 shares. कोई भी number of shares issue कर सकता है. Obliged to deliver a variable number of entity's own equity instruments. That means A Limited's own equity instruments are being delivered, and therefore if it is a variable number of shares to be delivered, the contract will end up being a financial liability. Doesn't matter if you are issuing equity shares. The standard tells, look at what you are settling. If the other party is absolutely clear that he wants his obligation to be fulfilled, he is not changing his hat of a liability. He remains to be a liability holder. Merely because you are issuing equity, you cannot say that this is going to end up being equity. He is not taking any responsibility. Uska payment to guaranteed hai. You are suffering you are bearing the burden of that liability. So therefore the contract continues to be a financial liability. Is it okay? Yes. From the vendor's perspective, it becomes a financial asset because this is an obligation to receive another entity's another entity's equity instrument. So obviously you will ask, sir, vendor क्या करेगा? यार vendor के case में what it is a contract. A financial asset is, look at the definition, it is any asset that is an equity instrument of another entity or a contractual right to receive cash or another financial asset from another entity. मिल रहा है ना मुझे? I am getting equity instruments of another entity. So for the vendor, in both the cases, it becomes a financial asset. Is it okay? Yes. Have you understood? Have you understood? Have you understood? Everybody has understood. Okay. All right. Fine. Let us move on to the next. Do you want a break or do we complete the definition? I will be taking another 15-20 minutes to complete the definition this side. Okay. Tell me. Do you want a break or shall we continue the definition? Okay, we'll complete the definition. All right, fine. Good. So let us move on to the next part now. Let us move on to the next. Acha, until this is settled, see, I was expecting a question, doesn't matter. Okay. Vendor delivered the asset. So this becomes which contract? Partially executed. Partially executed. Okay. So I have to recognize a liability. The liability has an obligation to deliver own equity instruments. And that is why in my books, I will pass the entry PPE account debit or purchases account debit to vendor. And now you have to ask the question, is this vendor a financial liability or equity? If this vendor is accepting fixed number of equity shares, depending on the price on the date of the contract, then this vendor will go and sit under equity. Okay, I mean this contract goes and sits under equity. But in the future, if this vendor says no, I need my 5 lakh rupees, मैं आपकी बात क्यों सुनूं, then this vendor will be continuing to be regarded as a liability. हाँ, जब when the settlement actually happens, you will pass the entry vendor account debit to equity share capital to securities premium. So that point of time, you will be recording the equity shares being issued. Here, there is no ambiguity here. The ambiguity arises until the settlement happens. So I have entered into the contract on 1st of March. Settlement should happen on 31st of May. So therefore, the whole issue is, as on 31st of March, who is this vendor? Is it a financial liability or is it equity in nature? Are you able to understand? Yes. Post execution, वो तो equity shares issue होगा ना यार. Then उसके बाद what he does is his job. He may take from you shares and sell them off immediately in the market. Doesn't matter. Then the equity shares will have equity features. But until they are settled, we have to decide on what the vendor is. Is he equity in nature or is it liability in nature? Is it okay? Yes. All right. So let us move on to the next part of the definition. So this was B1. This was B1. Okay. Now we move on to the next part. Now we move. Settlement in cash is always financial liability. Settlement in cash is always financial liability. There is no doubt about it. Okay. So you will look for fixed or variable only if it is in the entity's own equity instruments. And that word own equity instruments is very important. They will tell you, suppose A Limited purchases goods from the vendor, and in return, A Limited agreed to give issue shares of Reliance Industries Limited. If that is the case, own equity kahan hua? It is not own equity, and therefore it will not be covered in this definition. In this part of the definition, it will not be covered. Okay, so that is what you have to understand. Okay, now coming to B2. B2, if you see, it is now talking about a derivative contract. It is now talking about a derivative contract. Okay, so now suppose, what are the features of derivatives? There is always an agreed price, and that agreed price will always be different from market price. Always. It will not be very significant to the contract amount. So these things you will have to remember. In the previous example that we saw, was the price agreed? The price was not agreed, except in the first case, but that was the settlement that you determined. Okay. Otherwise, there is no agreed price of settlement. Okay. So in the contracts which are non-derivatives, agreed price hoga hi nahi. There won't be any agreed price. Why? Because they are entered on spot basis. They are entered on spot basis. The first case, when we saw that they were settled at 100 rupees per share, 100 is not agreed price. 100 is basically the spot price prevailing on 1st March. Based on that, you calculated the number of shares. But in derivatives, settlement happens at a future date, and therefore I will determine the price today for something that will be settled in the future. So if you have to distinguish between derivative and non-derivative in exam circumstances, derivative contracts will always have an agreed price which is given to you. Okay. So now let us take a particular example. Okay. Example. Suppose you have a startup. You are building a startup and you need funds. So I have a private equity or venture capital fund who is willing to invest. I have a private equity fund that is willing to invest. Now, the private equity fund is willing to provide, let us assume 5 crores. After 2 years. It is willing to provide 5 crores after 2 years. Okay. The question is, how many shares will go to the private equity fund? Okay. How many shares? How many shares? So the private equity fund will say, look, depending on your profitability, depending on the businesses you generate, the number of users, the number of what you can say, the traction that you generate in these 2 years, we will do a valuation of your shares and determine the number of shares to be issued. So is the price per share fixed today? Is the price per share fixed today? Answer is no. I am in whose books? I am not in the private equity funds books. Please remember, हम किसका accounting कर रहे हैं? I am the startup. As a startup, I have to issue shares to the private equity fund. So I am getting 5 crores after 2 years. But the private equity fund tells to me that, look, I'm not telling the number of shares to be issued now. We will determine the value later on, and then we will take the number of shares. So can you say that the private equity fund in some manner is protecting its interests of getting equivalent shares for 5 crores of investment? Yes or no? In our example here, private equity fund issues 5 crores, promises to give 5 crore after 2 years. That means the startup has to issue the shares, which is variable. Why it is variable? Because the private equity fund wants to get equivalent shares to its 5 crores. Are you able to follow? Yes. Are you able to follow? So in this case, my number of shares ends up being variable. Why it is variable? Because the private equity fund wants a equitable calculation for the amount it is investing. Yes. So therefore, can I say that the private equity fund is taking any risk? Answer is no, because it is getting equivalent amount for the 5 crores. It is getting equivalent amount for the 5 crore rupees that it is investing. Number one. Second case. So this was the first case. How many shares? Depends on the pricing. Depends on the pricing. It is very much similar to this case. कितने शेयर लोग हैं? पता नहीं, आपके market value के हिसाब से ले लेंगे. We'll take it based on your market value. So here also, we will take it depending on your valuations after 2 years. Okay. So 5 crores का हिस्सा will come depending on the valuation. Next case. Next case. I am not committing to any price. I am not committing to any price, but I am going to need 35% of share capital, of shares in issue after 2 years. I need 35% stakeholding in your company. बोल सकते हो 30, 35, 40, 45, whatever it is. Okay. So 35% of shares in issue after 2 years. Okay. So this is what is the demand that is made by the private equity fund. Okay. So depending on the profitability, all right, 35%, or you can keep number of shares fixed. But pricing will change. Pricing will change depending on the value after 2 years. Okay. So is it still in the nature of a liability? Yes, because the equity fund is having a hold on the entities share capital. In the sense, hold in the sense, there is a defined lot of shares which the private equity fund wants. There is a defined lot of shares which the private equity fund wants. So therefore, it is protecting its interests by requiring at least that much of investment in the entity, by requiring at least that much percentage stakeholding in the entity. Is it okay? Have you understood the second case? Have you understood the second case? Yes. Have you understood? It is placing a demand for a fixed number of shares. It is placing a demand for a fixed number of shares. Valuation depends on how much is there, but number of shares is fixed. That means how much I have to issue is fixed on that. In the first case, amount equivalent is fixed. In the second case, the number of shares is fixed. In the third case, both are variable. Number is variable, price is variable. Both of them are variable. Depending on your performance, we will decide how much to invest. We will decide at what price we will accept the shares from you. Are you able to understand all these three cases? Are you able to understand all these three? First case, commitment to 5 crores. Uske equivalent shares will come to you. So that is the first case. Second case, total number of shares invested is fixed. So therefore, can I say that in both the cases, the first two cases, the private equity fund is exhibiting a liability nature because it is fixing its own stakes in the startup. It is fixing its own stakes in the startup. And third case, also, it is saying, depending on my interest, the number of shares could be variable or price could be variable, whatever it is. But my interest is of prime importance. Based on my interest, I will accept the number of shares from you. So in all these three cases, what is the nature? I am having price, I am having number. Two determinants to own equity instruments. I am a startup, remember. So for the startup, this is a derivative contract. I am in whose books? I am in the books of the startup. Okay. So now price is variable. Agreed to get what you can say, price is variable. Yes. Number could be fixed. This is my second case. 35% equity shares in issue or these many shares. But the pricing will change depending on the ultimate value that the private equity wants. So this is exhibiting a financial liability feature. Alternatively, you can fix the price, play around with the number, and meet the requirement of 5 crores. So this is again a financial liability. Third case, I play around with the price, I play around with the number, but ultimately I need my pricing of 5 crores. And therefore, this is also a financial liability. Ultimately, the startup has committed to give 5 crores. But how many shares or what is the ownership or what will be the price and the number is all variable depending on what the private equity fund stake interest is. Is it okay? So therefore, in all these cases, it ends up being a financial liability. But suppose the private equity fund says that after a particular number of years, I am going to buy these many shares at this much price. You are fixing the price. You are fixing the number right today itself. That means tomorrow the startup performs very well. The private equity will have lots of positive side. Whereas if the startup does not perform well, because of the fixed price, fixed number, the startup is also stuck and will bear the same losses as the shareholders do. And therefore, this contract ends up being an equity. So if there is a variability in either the price or the number or both, then the instrument is a contractual obligation in the nature of a financial liability, because ultimately the interests of the counterparty are being protected. भाई मेरे counterparty is the private equity. Private equity wants to commit 5 crores. अब उसके लिए I have to issue shares depending on a variable price, or issue shares depending on a fixed price, or issue shares depending on variable price and number, whatever be the scenario at the time of settlement. So therefore, in all the 3 cases, the risk is on me. वो तो मजे ले रहा है. He is taking 5 crore entirely. Yes. उसको कोई फर्क नहीं पड़ता आपका प्राइसिंग कितना, आपका स्टेक कितना, आपका नंबर कितना है. He wants his worth for 5 crores. After 2 years, he's taking that from you in the form of equity shares that suits the 5 crore liability that he has given to you. All right. But if he is a true investor, he will say on the date of agreement, look, I am investing 100 shares for 10,000 rupees per share. This is the money that I give. You can go and do the business with it. Then he is subjected to exactly the same number of the same risks, the same rewards as an equity holder is, and therefore such a derivative contract will be regarded as an equity, Did you understand this? Did you understand this? Yes or no? Bolo yaar. Okay, so now the question is how there is an agreed price. Okay, so what are the features of a derivative contract? Number 1, the features are, first one is, it is based on the value of the underlying. The movement in the price depends on the value of the underlying. So in this case, there is a contract which depends on the value of the shares of the startup. So my underlying is the valuations of the startup, number 1. Second one, is there going to be a future settlement? Answer is yes. There is going to be a future settlement. For third one is there initial payment to be done? Answer is no. 5 crore is going to be received after 2 years. So the agreed price is 5 crores. Agreed price is the lump sum investment of 5 crores. Depending on that lump sum investment of 5 crores, either my price changes or the number changes, or both of them are changing. So in this case, the commitment is 5 crores, which is made. But how is this 5 crores getting compensated for? This 5 crores is getting compensated for either by issuing fixed number of shares for a variable price. When the startup says, I want to invest 30%, I need 30% shares of yours. So that is, he is fixing his stake. Second one, price is getting fixed and number of shares ends up being variable. Or third case, when the private equity is in a strong position to negotiate, it is variable. So this is the fixed, this is the price agreed. Settlement at a future date, this is to be paid after 2 crores. Right now, nothing is payable in significant amount. So all the features of derivatives are met. Okay. And in the last case, he commits, the private equity fund commits that we will issue this many number of shares at this price. We will take it from you and then you issue the shares to us. That's it. Fixed. It is fixed. Nothing else. All right. So that takes care of the definition of financial liability. Remember, this is also known as a fixed for fixed test. Which test? Fixed for fixed. Whenever you are entering into a contract, if the number of shares are fixed, the price is fixed for the equity shares which you are delivering. Which equity share? Own equity shares. Own equity shares you are delivering. Then if the price of those shares are fixed, if the number of those shares are fixed, then usko hum log bolte hain fixed for fixed. And fixed for fixed test is satisfied, then it means that the contract is an equity contract. Then it means that the contract is an equity contract. If any one factor is variable, that means either price is variable or the number is variable or both are variable. If any of these things vary, then the contract is a financial liability, because you are obligated to deliver either a variable number of shares depending on variable price or variable number or both. So that is what you will have to understand. So if you have understood the whole discussion till now, well and good. In case you have not understood, just remember that if both are fixed, the contract is equity in nature. If even one of them is variable, could be both also, then the contract ends up being a financial liability. Let us quickly look at the definition. A contract that will or may be settled in entity's own equity instruments. So important one is the startup is issuing its own equity shares and is a derivative. Why it is a derivative? Settled in future, price of 5 crores is agreed today, and finally today nothing is payable, no margin money, nothing, everything is paid at the end of the second year when the settlement actually happens. So all the three conditions are fulfilled, the transaction becomes a derivative that will or may be settled. Now look at the words, other than by exchange of fixed amount of cash or another financial asset for a fixed number of the entity's own equity instruments. So what is it saying is, a contract that will or may be settled in the startup's own shares and is a derivative that will or may be settled other than, that means exchange of fixed amount of cash, 5 crores in our example, or another financial asset. Okay, forget other financial asset. I am getting 5 crores and in place of 5 crores, I am issuing a fixed number of own equity instruments. If price is fixed, quantity is fixed, then this part is an equity. So therefore, it is saying anything other than this. That means if either price is variable or number is variable or both are variable, it ends up being a financial liability. Is it okay? Yes. Have you been able to understand the definition? Yes. Have you been able to understand the definition? Future settlement, price is fixed. Shriram, did you follow? Janvi, did you follow? Yes. Viraj, did you follow? Purnima, Akash, Jain, who else is there? It is okay, all clear. Kaushiki has confirmed. Namrata, did you follow? Yes. Okay. All right. Okay, fine. Now, same definition is there for financial asset also. Ab dekh sakte ho. You can have a look here. A contract that will or may be settled. See, this is financial asset. Yes. Will or may be settled in entity's own equity instruments. A non-derivative for which the entity is or may be obliged to receive a variable number of entities' own equity instruments, and or derivative will or may be settled other by exchange of another financial asset for a fixed number of shares for fixed number of entities' own equity instruments. Is it okay? Yes. What we will do is we will take a 5-minute break. Okay. If you want, otherwise I can continue discussion. You guys need a 5-minute break or we'll continue? You need a 5-minute break? Okay, fine. We take a 5-minute break. It's just 5 minutes. It's 9:25 now. We shall meet at 9:30. I will quickly complete the definitions. So then with that, we should be in a position to try some questions for homework. Okay. So I want to finish the definitions today. 5 minutes. We resume at 9:30. Okay. Yeah. Fine. So we have ended the definitions on financial liability. Yes. Finally, one part is done. Yes, we have covered all the points and we have discussed all the possible. Hello. Okay. I think there was some audio issue. Yes. Okay. So we have completed the discussion on financial liabilities. We quickly run through financial assets. These two similar clauses are there. And once that is done, we will proceed with closure of the first unit. Okay. So now let us again come to some examples. Okay. Similar examples. This is particularly D1. Okay. I am discussing clause D1. Okay. So this is a non-derivative. Okay. So similar case, in the first case, X Limited purchased goods or machinery from the vendor. In the second case, we are having clause D1 for assets. Obliged to receive, look at the words. A non-derivative for which the entity is or may be obliged to receive. Okay. So now coming back to our example, I have a company A Limited. I sold goods to my customer. I sold goods to my customer. So the sales value, same values I am taking, rupees 5 lakhs. I have sold goods worth 5 lakhs to the customer. The customer is holding my own shares. The customer is holding my own shares. See, it has to be understood as a contract that will or may be settled in the entity's own equity. So A Limited's own shares. So customer owns A Limited's shares. A Limited's shares. उसके पास cash नहीं है, but he is having A Limited shares. So what the customer says is, see, I will pay you your own equity instruments. I will pay you your own equity instruments. Okay. So now understand. This is very interesting, quite different from what you have studied till now. So suppose the credit period is 2 months. So 31st May, the issue happens and I am going to issue shares to A Limited. Now, let us assume that the number of shares that the customer has is 10,000. 10,000 shares of A Limited are going to go back to A Limited. Total shares in issue is equal to, let us assume 1 lakh shares. Let us assume 1 lakh shares. Okay. So now understand this very carefully. A Limited has issued in all 1 lakh shares. Out of 1 lakh shares, 10,000 shares are held by the customer. 10,000 shares are held by the customer. That means the remaining shares with the outsiders are how much? The remaining shares with the outsiders are how much? Sir, 90,000 shares are there. The remaining shares with the outsiders are 90,000. Now, if the contract says the customer will issue 10,000 shares. Okay, 10,000 shares, 5 lakhs by 10,000. 1 second. Just a minute. Okay, the price of the share is rupees 50 on this date. Okay, it's not required, but I've just put it there. So 10,000 shares of A Limited will go back to A Limited. Customer will issue that. Now, on the first day, when the sale happens, the entry passed is customer account debit to sales 5 lakhs. This is the entry that will be passed. Now the intention is customer will send the shares, will sell these shares, or I won't say sell. As part of consideration, the customer will return A Limited shares back to A Limited. The customer will return the investment it has in 10,000 shares of A Limited back to A Limited. Okay. All right. Now, answer my question. As per the agreement, 10,000 shares should go. Answer my question. First one. If price is rupee 1, rupee 5, rupees 7, rupees 10, rupees 50, rupees 100, rupees 200, basically whatever be the price of the share, A Limited has contracted to receive the entire 10,000 own shares from the customer. Is it okay? In other words, is the customer getting a guaranteed return on 10,000 shares? See, the customer has a liability of 5 lakhs from A Limited. Dhyan se suno, it's not very confusing. The customer has a liability of 5 lakh rupees because it has purchased the goods from A Limited. The contract says that the customer will deliver 10,000 shares of A Limited as consideration for the sale value it has received. Okay. This 10,000 shares is going to be delivered regardless of the price. That means price could be 1 rupee, 2 rupees, 5 rupees, 10, 15, 20, 100, 200. कुछ भी हो उससे कोई फर्क नहीं पड़ता. 10,000 shares जाएंगे A Limited के पास. So can I say that on these 10,000 shares, the customer is getting a guaranteed return of 5 lakh rupees? Can I say that there is a guaranteed return of 5 lakh rupees? Yes or no? Can I say that if the customer gives the 10,000 shares to A Limited, the liability of 5 lakhs vanishes? Yes or no? It is consideration. So if consideration is vanishing, can I say that the guaranteed value for 10,000 shares is 5 lakhs? Don't look at, price and number ends up being fixed. I'm not looking at this price by the by. It is coincidence that the price is 50, but it could be any price, 1, 5, 7, 10, 50, 100. What I want to say is the 10,000 shares of A Limited getting a guaranteed value? Answer is yes. Now, since it is getting a guaranteed value, can I say that it is no longer meeting the definition of equity? Can I say that it is no longer meeting the definition of equity? Why? What is equity defined as? Equity is defined as residual interest in the entity's assets after deducting all liabilities. In respect of these 10,000 shares, you are not giving a residual interest. You are giving a guaranteed interest of 5 lakhs. Equity में guarantee नहीं चलता है. Equity gets his share after all after all liabilities are deducted from assets. But in this case, these 10,000 shares are having a liability of 5 lakhs. And therefore, can I say that for these 10,000 shares, there is a guaranteed return? There is a guaranteed return for these 10,000 shares. Yes or no? And because there is a guaranteed return, the remaining shares, 90,000, will exhibit equity features. Did you understand this? Are yes or no? Have you understood this part? That means in my equity share capital, I have 1 lakh shares. Against this 1 lakh shares, 10,000 shares have a guaranteed return. So only 90,000 shares are exhibiting equity features. That means what? I have to eliminate 10,000 shares equivalent from the definition of equity, because against 1 lakh, I am giving a guarantee for 10,000 shares. I am giving a guarantee for 10,000 shares. Did you understand this? Did you understand? Yes. Yes. Is it clear? Okay. So a non-derivative for which the entity is or may be obliged, it is a contract, a financial asset is a contract that will be settled in the entity's own equity instruments, is a non-derivative. I'm actually getting an asset and issuing shares. It's not happening in the future. It's happening based on the credit terms, and there is no agreed price, for which the entity is or may be obliged to receive a variable number of entities' own equity instruments. Okay. So therefore, wait. How will the entity record is another question. Right now, I'm not coming to that. I'll come to that shortly. Please wait. Okay. Now, if I am giving a guaranteed return, these equity shares are actually not equity in nature. These equity shares are actually not equity, are actually not what you can say. They don't have a residual interest. They have a fixed interest. They have a fixed interest. So the entry that you will pass is, you will have to remove, your equity is currently showing 1 lakh shares. But equity features exhibited are only 90,000. So therefore, you will have to debit other equity. So other equity account debit to sales. This is what you are going to pass. This is the entry that you are going to pass. Instead of customer, you will end up debiting other equity, or you can designate the customer as being other equity. Is it okay? The buyback has not yet happened. The buyback has not yet happened, but you have agreed. So on 1st March, you will pass the entry other equity account debit to sales. And when the actual buyback happens, you will pass the entry equity share capital debit to other equity. Equity share capital debit to other equity. This is the entry on 1st March. This is the entry on 31st of May. This is the entry on 1st March. This is the entry on 31st of May. Okay. You will not debit equity capital on 31st May because you have not received the shares. The shares are getting transferred on 31st of May. But on 1st of March, this instrument reflects non-equity features. It reflects non-equity because you are giving it a guarantee. You are giving it a guarantee. So that is why we will have to eliminate it. That is why we will have to eliminate it. Okay. See, I am not debiting financial asset because I am assigning. Okay. Understand it like this. See, I have equity share capital 1 lakh shares, whatever be the amount, Okay. Now, this is a credit balance. Agreed. But out of 1 lakh shares, 10,000 shares, are they exhibiting residual interest or are they exhibiting fixed returns? Sir, they are exhibiting fixed returns. If they are exhibiting fixed returns, they cannot be equity. So my actual instruments exhibiting fixed returns are not 1 lakh. It is only 90,000. Actual equity is only worth 90,000 shares. On the remaining 10,000 shares, I don't reflect anything. I don't reflect equity features. I have given a guarantee of 5 lakhs for that. And therefore, I have to remove it from here. And that is why I am debiting other equity. I am debiting other equity. I am not debiting other equity because it is equity. I am debiting other equity because it is not equity. Are you able to understand the difference? I am debiting other equity because I have to exclude it from here. I have to exclude it from the equity component, but I cannot debit equity capital because the buyback has not yet happened. I have agreed to a buyback. The buyback has not yet happened, so I cannot debit equity share capital. That is why I am debiting other equity. Okay. So this is how you are going to record it. This is how you are going to record. So basically, I have given a fixed return, a fixed guarantee. So other instruments are reflecting equity. That is why I have to cancel these 10,000 shares. So on 1st of March, I will book the entry other equity account debit to sales. And on 31st May, it will be whenever the buyback happens, equity capital to other equity. Depending on face value, you will adjust the reserves also. Okay, I think you have premiums or those kind of reserves will be adjusted to complete the buyback. Okay. Now suppose, abhi zara dhyan do. I don't agree for a buyback of 10,000 shares. Who? A Limited. A Limited bolta, why should I take entire 10,000 shares? Okay. Which you are going to study. Basically, other equity is all items relating to equity features. Okay. Anything that is related to equity feature will come and sit under other equity. It cannot be equity share capital. But then the standard says equity kaha bolta, it should be equity shares. Equity is just an instrument which evidences residual interest. Naam kuch bhi de do. There is even no need for voting rights. Residual interest is there, that is enough. So reserves, all these adjustments, everything will go and sit under other equity. Okay. So other equity is non-shares item which go and sit, which are in the nature of equity, Okay. All right. Coming to the next case, I'll modify this and say that why should A Limited will say, why should I take 10,000 shares from you? I will take the shares because I don't have faith on my own share prices. ऐसे A Limited, मेरे को अपने share का भरोसा नहीं है. So I will not take 10,000 shares from you. Instead, I am going to take a variable number of shares depending on the pricing on 31st of May. Are you able to correlate with the vendor? Yes. So A Limited wants to protect its interest. A Limited bolta hai, I will not accept 10,000. I will accept 5 lakhs only. But how will I calculate the 5 lakhs? Based on the price which is there on that day. Based on the price which is there on 31st of May. Based on that price, I will receive 10,000 shares. I will receive variable number of shares from you. And therefore, who is having the risk? Do you think A Limited has a risk of 5 lakhs or now the customer has a risk? Because earlier kya tha? In case 1, what was the scenario? Customer was guaranteed 5 lakhs. But now the customer is not guaranteed 5 lakhs. Customer is dependent on the movement in the prices. That means, can I say that customer is now having equity features? He will also feel the pain when the price drops. He will also feel the pain when the price, he will also feel the gain when the price rises. So can I say that by virtue of A Limited not agreeing to a fixed number of shares, can I say that equity risks remain with the customer? So if equity risk remains with the customer, can I say that this cancellation is not going to happen because there is no guaranteed return. And if there is no guaranteed return, can I say that the number of shares with equity features continue to remain at 1 lakh? And if it continues to remain at 1 lakh, can I say that I cannot treat it as other equity because I have 1 lakh and all 1 lakh shares are exhibiting equity features. So therefore, nothing will be cancelled out. And if nothing will be cancelled out, what do I debit? I am not getting cash. I am getting my own shares. Something has to be debited. Na customer cash nahi dene wala hai. So therefore, what does it represent? It represents a financial asset. And when the buyback actually happens, I will debit equity share capital and credit financial asset. I will credit financial asset. Is it okay? Thoda sa it becomes difficult to follow because we have not seen the way financial statements are viewed in this standard. हमने अभी तक देखा नहीं है. So that is why it is a little bit difficult to understand. But this is how the things work. By virtue of a contract, what is the nature or what is the implication in my financials? So far, the accounting was based on legal form, but now we are going very deep into the substance of each transaction. And that is why it is important for us to look at how, okay? Look at how the transactions are structured. Did you follow this? Yes. So if there is no guaranteed return on 10,000 shares, equity features are exhibited on all 1 lakh shares. And if equity features are exhibited on all 1 lakh shares, I cannot debit other equity. That is why I will be debiting financial asset because I'm not getting cash for this. I'm not going to get cash. I'm going to get my own equity instruments. So I will have to debit financial asset. The customer is a financial asset. Okay. And against that financial asset, I'm going to get equity shares. Okay. Is it okay? Have you understood? Yes, boys and girls. Janvi is there. Kaushiki is there. Viraj confirmed. It's a bit difficult, but I need you guys to confirm. Any doubts, please ask. I don't mind spending part of the next class again on this definition. Okay, don't think I'm hurrying. We will discuss the second part in the next class if you want. Okay, we will discuss the next part if you want. Okay, but I need you to be clear about today's part. All good. Shriram confirmed. Tushar confirmed. Kaushiki, did you follow? Janvi, did you follow? How will the entity record receipt of shares? Depends, na? Equity share capital, entire 10,000 will be bought back. So 10,000 into face value will be debited. Then we will credit the financial asset or other equity as the case may be. Difference is your surplus on buyback or loss on buyback, which we will adjust in the reserves. Okay. All right. So that takes care of the first part of this D1. Okay. So we have discussed C1, C2, D1. What is left is D2 introduction. I want you to look at these examples. We have discussed most of them. Okay. Cash, contractual right. I need you to look at that. I need you to read physical assets, prepaid, perpetual debt. I have discussed irredeemable debt. Okay. I want you to look at this example 1. I want you to look at illustration 1. I want you to look at illustration 2. Liabilities, we have covered everything. So example 2 you can go through. Example 3 you can check. 4 you can check. 5 also you can do it. It's manageable. Equity instrument, go through. No contractual obligation, I have told you. Settlement in own equity instruments, I have discussed. Fixed for fixed, that is the same thing discussed. Example 3 you can go through. Preference shares I have discussed with you in detail. Non-redeemable also I have discussed. Distributions I have discussed. Preference shares with non-cumulative I have discussed. Okay, quite a bit we have discussed. Okay, non-derivative, derivative I have discussed. So you can check illustration 7, illustration 8, and then this comparisons also you can go through. Only thing what is left from my side is this part. I'll be doing the example and you will be able to understand it in the next session. Okay, so financial assets, this one is pending. That's it. Scope you can go through. It's largely theory, but you may understand some, not understand some, but just cover it up. And then own exemptions we have discussed. Okay, so from my side it is just a discussion of that small D2, clause D2 of financial assets. I'll discuss that in the next class, and then we move on to classification and measurement. Okay, very important. We are having the next class on today's Tuesday, Thursday. So Thursday, Friday, Saturday, Sunday will be our continuous classes. I need you, preferably if you can, sit with a laptop, because if there are some questions I will do, I may do it on Excel, because I want to save up on time and I need to explain a lot of things. I don't want to waste time on solving, because there are a lot of present value calculations which will come after maybe the third class. Okay, so have a laptop if you can. Okay, because we need to understand the concepts and go through these what I have told you to go through. Okay, I know you don't have time, but we'll have to go through. If you don't revise the same day, you will be in a deep mess. Okay, so just be careful about that. Okay, and if there is any issue, please feel free to write to the institute. It is a very important topic. I don't want that you should not go without adequate understanding. Okay, all right, fine. Thank you for today. See you guys on Thursday. Okay, thank you.